statue and the whole thing. It'll be, we'll play it at the next to his, where we have the exhibit.
Just stream it.
Yeah, that's a good idea. Okay, 2 seconds here and we'll get going. Okay, ready to go. Good morning and welcome to the Catholic Investment Services Fireside Chat with two Philadelphia Catholic business and civic icons, Jack Brennan and Jerry Maginnis. Thank you for joining us today. My name is Tom Lanctot, and I am privileged to serve as Chief Executive Officer of Catholic Investment Services. Joining me is my colleague, Zayla Astarjan, who has done a great job organizing this program and is at the Zoom control panel. Enormous thanks to our wonderful friend, Jerry Maginnis, for his terrific leadership and hard work in making this session possible. As some of you know, we had planned to meet earlier this year at the Union League Club, and we appreciate you joining us in virtual mode, even without the eggs and scrapple. Today's format will be conversational between Jerry and Jack. There will be plenty of time for questions after the formal part of the program. So when prompted, please use the Q&A feature, not the chat feature, but the Q&A feature on your Zoom screen to submit a question. Everyone other than our panelists will be muted and the call is being recorded. Catholic Investment Services was founded by Jack Brennan and Scott Malpass, the legendary Chief Investment Officer of the University of Notre Dame, to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit serving other Catholic nonprofits and hope this webinar provides some useful take-home value. Zayla provided biographical information for our speakers, and I'm guessing that for many of you, Jack and Jerry are old friends. Before we begin our formal business, please join me in a pandemic prayer that we've borrowed from the Sisters of the Holy Cross. Dear Lord, may we who are merely inconvenienced by this pandemic remember those whose lives may be at stake. May we who have no risk factors remember those who are still vulnerable. May we who have the luxury of working from home remember those who can't work from home and have to make difficult choices. May we who have the flexibility to care for our children and grandchildren when schools close remember those who have no options. May we who have to cancel trips and vacations remember those that have no place to go or can't afford a vacation. May we who might lose money in a tumultuous economic environment remember those who may not have money to lose. May we who can settle in and be safe in our homes remember those who have no homes. And during this time when we cannot physically wrap our arms around each other, let us find ways to be the loving embrace of God to all. Amen. Amen. Now I'm pleased to hand the program over to Jerry.
Hey, thank you, Tom, for that gracious introduction, and good morning, everyone. We're delighted you could join us this morning. Our format is that I'm going to ask Jack a few questions here. We'll spend maybe the first 20, 25 minutes just covering some of the topics that were addressed in the materials you received promoting the program. But then we'd really like to get to your questions and kind of hear what's on your mind. Tom went through the way you can submit your questions, and please start sending them as soon as they cross your mind, and we'll try and address those as they come in. So Jack, welcome. Glad we could all be together virtually here this morning. I think most of our audience probably knows that you've been involved at Notre Dame for quite a while and that you're currently serving as the board chair. They may not be aware that Notre Dame's endowment has been one of the top performing endowments in the country for really the last 20 years. And I guess I did a little homework in preparation for the program this morning, and I see where the distributions, the spending from the endowment over that period has approximated $4.6 billion. That's $4.6 billion that's gone back to educating students and helping with the university's mission. At the same time, that endowment has experienced dramatic growth. So maybe just to kick off here, give us a little flavor for some of the strategies you all have employed at Notre Dame to sort of grow the endowment and have some of the investing success that you've had over the years.
Happy to do that, Jerry. First, let me just say thanks to our visitors and our guests. I wish we were doing this in person, but it's in a sense great to be in Philadelphia and able to do it. And Jerry, thank you for helping organize this. You've been a great friend of Catholic Investment Services. So I'll tell you just a short story. My oldest son applied to Notre Dame early, got accepted, sent in a check, and within 5 minutes there was a Notre Dame fundraiser in my office. It was very interesting. And his guest was Scott Malpass, of all people, the head of the endowment, who I knew by reputation but didn't know. This is 18 years ago now. And same kind of thing. I knew the record. And I said to Scott, so I know the record, but tell me what that means. Without blinking an eye, he said to me, I'll tell you what it means. A top student who used to turn us down, this hit home a little bit, to go to Dartmouth, now turns down Dartmouth to go to Notre Dame because we're need blind, and anyone who wants to come to Notre Dame can come to Notre Dame because we have the resources to meet their financial need. It left a big impression on me as somebody who knew really nothing about Notre Dame as an institution, right? I knew what the average man on the street knew. And that has really played out. So, fast forward a few years, I went on the Board of Trustees, went on the investment committee, and you got to see the kinds of things that they have done. They did early, importantly, and then that have really differentiated. They are the 1, 2, 3 top performer over 20 years in the university endowment world. And a couple of things I'd say first. One, deep commitment to balance and diversification as a core part of the investment strategy. Plain and simple. It's not glamorous. It's what you learn in Investing 101, but balance and diversification. And they've increasingly diversified the portfolio over the years. In the when Scott took over 32 years ago, excuse me, it was stocks and bonds. Systematically, it became, in a sense, it looks the same if you look at a pie chart, but the subcomponents are different with hedge funds and private equity and venture capital and globalization. But it's always been around this mantra of balance and diversification. So that's point number one. Point number two is it's always been designed to be a long-term success, not necessarily a short-term success. Critical part of what it takes to be successful is to look through the noise, tune out the noise, look through the headlines, and think about 5 and 10 and 20 years from now. So that long-term orientation has been key. The third thing that I would say that they've done is it's not money, it's mission. You hit the numbers. Notre Dame's a very different place because of the resources it has, because of two things. Wonderful benefaction from the people in the Notre Dame family, just to be clear, who provide the resources, and great stewardship, both on the daily financial management of the institution, which is not always true in academics, and importantly, from an investment standpoint. So, for me, that the balance and diversification is a core. The details have changed a lot over 30 years. The idea that it's about long-term and your measurement criteria are long-term, and then it's tightly linking the purpose, i.e. the mission, to the money. And sometimes people get confused that it's about the money. It's never about the money. We come back all the time and say, we've got one purpose here. It's to serve the students and the faculty in the interest of driving the mission of the university, which is to send young people out into the world who will make the world a better place. That's a pretty simple mission in Notre Dame. And I think those lessons are relevant whether it's you're a small Catholic high school or a large Catholic university or any institution. And I've been involved with places that haven't gotten it right like that over time, not nearly as well. The stewardship maybe not as good, not linking the money to the mission, but it's a powerful force. A place like Yale has done that. Same thing. And Yale and Notre Dame go back and forth with a couple of others who rotate through on the 20 and 25-year performance criteria. The last thing I would mention, by the way, is having a 30-year plus chief investment officer replaced after his retirement in June by a 28-year, I think, partner is tremendously valuable because you get a consistency of application of those principles. Probably longer-winded answer than you want, but it's not a unique Notre Dame story, but it's too rare in, frankly, endowment and foundation management to have those three things applied so consistently over decades, through good and bad markets, and through periods where you're going to perform well and where you won't perform quite as well. But as long as you keep your eye on that mission at the end, and you're consistent, you can be a winner in this.
Yeah, no, really good stuff. Thanks for sharing the background, Jack. And sounds like real good succession planning there too that you touched on at the end. So you sort of alluded to where I was going to go next. A skeptic might say, well, of course, Notre Dame's got a great endowment. They have a lot of wealthy people that have contributed over the years, and they can sort of hire the best and brightest to run it. But what if Villa Maria Academy or a local, Philadelphia area Catholic high school or small university, what sort of challenges might they face? Do the same principles apply? What advice would you offer them? Many of them are represented in our audience today.
It's a question I get asked all the time, Jerry, and it's a great one, and it's an important one, frankly, for a smaller pool of capital to ask themselves. And there's two questions. One, if you have an endowment or if you try to establish endowment, let's assume there's an endowment in place. For me, the issues are exactly the same, whether it's 10 million or 10 billion. And first, committees have to understand they're overseeing a crucial pool of capital that is important today and important 10 years and 20 and 50 years from now. And so you start with that. It's not a plaything. This is and so it shouldn't be fun. I've had people say that. I like being on the investment committee because it's fun. It's a crucial pool of capital, point number one. Point number two, you do have to take a long-term outlook, and it's really tough because there's nothing but noise out there about the markets. Why KYW reports on the markets at the open and at the close is just silly in the grand scheme. It doesn't matter. This is not the Phillies game. It doesn't matter. So that long-term outlook is critical, and it's perpetual in many ways. Third, you got to think about what are your objectives, and one of them for a perpetual pool of capital is you really need to be willing to take enough risk to produce returns that will outdo inflation and keep your real purchasing power in place. The safe choice is, buy T-bills. You never lose money, but you'll lose purchasing power. And so getting that balance right, but being willing to take risk is important. And again, in our case, in Notre Dame, we went into venture capital and private equity and a bunch of things before anybody else did. It was risky, but it's paid off in spades. The fourth is the unglamorous way to invest is balance and diversification. In some ways, it's not that much fun because you're never going to be the top performer in a short-term period of time because somebody who leveraged stocks in a bull market is going to do better than you did. But the point of an endowment is the return and the ride to get that return. And doing this, I guarantee you will take money out at the bottom and you never get it back. So what you want is the smoother ride, and that'll cost you a little return versus whatever the best performing asset class is, but you have to have the discipline to deal with that. And then the fourth thing that I always think about, and I tell people, is get all those things right, and you still got one other challenge, and that is you got to pay today's bills. So you're trying to think about the next building, or you're trying to think about financial aid for students 10 and 20 years from now, and you got to pay the bills. And I come back, and what I say to people is you've got to figure out what your annual stewardship is and how dependent you want to be on the endowment, because the endowment will be volatile, should be volatile. Tough thing to get right, to balance. And, you go back to the global financial crisis, a fabulous institution, fabulous endowment like Princeton borrowed $1 billion to meet current expenses, because they had that mismatch wrong. Harvard had some severe stress because they had invested their cash in the endowment pool. The endowment pool's for the next 100 years. The cash is for this week, and they lost a ton of money. They're smart people. The Princeton thing I know worked out. Harvard's doing fine, but that tug between short-term needs and long-term financial stability is one that investment committees, again, whether you're 10 million or 10 billion, have to get correct. And I think it has a lot to do with merging the investment and then traditional stewardship functions to make sure they're not separate at all. And again, the best places, and I've seen some fabulous small institutions. I've met a lot of them through Catholic Investment Services over time who really get these points correct. And I've been around large ones that don't, to be honest. My alma mater, not as doing better now, but in another year, not so well on this stuff. And I think they're 5 very simple points, but hard to execute against.
Yeah, and Jack, you're getting into some really important governance principles, and I'm going to come back and ask you about that in a moment. But just sort of staying with, how to best make that match, right? Everybody that has an endowment probably has a draw on that endowment and a spending policy where they look to kind of help support paying the bills in many tuition-dependent organizations that we have represented in our audience today. And we're in the middle of a pandemic, right? So times are tough. Revenues are down in many instances. There's a real temptation to maybe dig a little deeper, bump up that spend rate. Any advice for the audience on that front?
Don't do it. Don't do it. It's, you know what Murphy's Law is, right?
Absolutely.
And do you know what O'Toole's corollary is?
Not sure I do.
Murphy was an optimist. And O'Toole's corollary says, if you just bump it up for a little, you're going to end up with the market tanking. And again, you never get that money back, right? You've eaten your seed corn. But it's why living below your means is such an important thing, Jerry, because you can be in a pandemic, and the better you've stewarded yourself up to that point in time, the better flexibility you have in terms of managing your expenses. But tapping the endowment, there's been a lot of controversy about it. There was in the spring. Why don't universities just go reach into the endowment and take a bunch of money out? And they didn't, and they were smart not to do it. It's an unbelievable challenge. I, for one, would rather borrow money than take it out of the endowment, personally, in that regard. But the macro point is what you're alluding to. Draw as little as you can, right, as is prudent. I told you a story about a startup endowment that an important constituent of Vanguard got, and they asked me to come help with a guy who ran the Harvard endowment to think about. And so they didn't have the money. They suddenly got $2 billion. And people are going, whoa, at 5%, there's $100 million more we can spend. And we got the management team to agree that they could only spend 2%. Because it was found money, right? Fast forward to 2008, the endowment hit a mountain, and they were fine because they weren't wholly dependent on the endowment, because they spent what they needed to, not what they could. I think that's the mantra. And don't spend more because your endowment goes up in value. You don't do that with your 401k plan. Why should an institution do that? But people are tempted to do that. And my view, that's one of the stewardship challenges that leadership has to get their hands around. You'll go through a pandemic, you'll go through the global financial crisis, you go through other tough periods of time much better if you go into it having been very prudent, rather than thinking good times will roll for a long time more.
Yeah, great points, Jack. And I think it goes back to that think long term. So shifting to governance, what are some best practices for investment committees? And again, many Catholic institutions are focused on Catholic socially responsible investment policies. How do you weave that into the mix? Maybe touch on those couple points.
Let me start with the last one. I think it's such an important thing for Catholic institutions. And, it's one of the core differentiators, interestingly, in Notre Dame's investment strategy. It's been screened for social values for decades, and it has not cost anything in return. And too often people think that a screening process will cost them return. Well, Notre Dame's endowment is, and there are lots of others, but the one I know best is, you look at the returns, it's probably enhanced their returns. been tremendous. So I think you have to make that decision right at the top. Are we going to do that? We happen to think institutions should do that. So start with that as a discussion, because it's important. It will dictate where you invest, frankly. Okay, very importantly. But there are so many things that you need to set up procedures for the committee. When do you meet? What do you do at the meetings, and so on? That sounds bureaucratic, but it's important to have the disciplines, because again, it's too tempting to make this fun. It's not fun. This is serious stuff. So having a mission statement, having a set of procedures is job one. And then very importantly, job 1A is to establish an investment policy, objectives, and guidelines. It sounds easy, but getting that right is important. How do we think about our risk tolerance? Okay, it's again, do we have the same risk tolerance as Harvard or Notre Dame? Maybe not. Or do we have more? Who knows, right? But you have to get that right, because it's too easy to understand. So the risk tolerance is vitally important. Then you get to what is the objective? And they're one and two. Is it to grow? Is it to maintain purchasing power? How do we think about that? What are our other sources of capital? Are we an effective fundraising organization, so we'll replenish over time, and so on? And so the objective, and then the guidelines. I mentioned that one of the core ones for Catholic institutions, obviously, is, are we going to, however we define the guidelines for Catholic social values, is it the ones we use, which are the U.S. bishops, or is it something else? And then, do we want to do separate accounts? Are we willing to do pooled funds? You could go down the list of things. And then you get to implementation strategies. And then, very importantly, one of the places that a lot of committees, and very sophisticated committees, come up short is, what are your benchmarks for success? It's interesting. We're right in the season now where they're reporting on university endowment performance, and big headline, Brown leads Ivies for third year in a row. Well, good for Brown, but who cares? And it's really tragic in some ways in the more sophisticated world that annual performance has been something people report on. It makes no sense. And frankly, I don't know whether Harvard cares what Yale does. They have different financial pictures, different financial demands, different dynamics. It's got to be your sense of how you evaluate your performance has to be against a subset of one, which is what matters to our institution. You can look at what others have done. It's kind of interesting, but the reality is the only financial metrics that matter are your financial metrics, not how a peer institution did, because you simply don't know whether they're taking more or less risk, whether they can take more or less risk, and so on. So that's how I think about a very effective investment committee. And it's hard work. It's hard work, because I said people like to be on the investment committee because it's sort of interesting, and you learn. But getting that investment policy, the objectives, and then the guidelines and the measurement criteria correct. And correct is in the eye of the beholder. But I'll tell you, Tom and his team have produced an incredible document that I was really impressed when I got it. It's called "Securing the Future of Your Catholic Institution," and it's as good a 16-page guidebook for how to do this. You could. There are a lot of consulting firms that would charge $100,000 for them, and this is free. So anybody on the call who's interested, and I think maybe we're going to send it. I think maybe Tom said.
My understanding is that in lieu of the eggs and scrapple that we had hoped to serve at the Union League, we're going to be sending that book out after the fact. So I think that'll be a terrific resource. And it's fascinating, Jack, as I listen to you, what a lot of people would view to be sort of a complex topic / area. Global markets and some of the things you've touched on, you're breaking down into some pretty basic principles, right? Like have a plan, have a target, have a benchmark, measure yourself against it, meet regularly, define your mission, blocking and tackling, right? But a lot of people don't do it.
This is what you do for the Maginnis family. And it's exactly the same thing. And you take it very seriously for the Maginnis family, but you don't hire Cambridge associates to help you. It's blocking and tackling, and it's just, the other thing that I would say that I should have said, and it's in the implementation, find the trusted partners. I go back to Scott Malpass, and one of the things that, after I got over the cheap shot at Dartmouth from him in my first meeting, I'm just drilling down. I'm an incessant questioner. And I was just asking about how they've done what they've done. And he kept using a term that caught me off guard a little bit. He didn't talk about his investment managers. He talked about his partners. And it's really interesting mindset. Both ways, by the way. Both ways. There are conference rooms at some of the most elite investment firms in the world named after that. It's the Notre Dame room. That's how much they respect the team in South Bend. But it literally is a partnership. It's not a vendor-client thing. And finding that trusted partner or partners is a critical part of this, right? And it's getting that right is a huge part of the battle once you get the blocking and tackling done. And that's the fun.
A great segue, Jack. Sorry to interrupt.
No.
Catholic Investment Services was really your brainchild, along with Scott and some others. And love to kind of hear about the genesis of the organization. What did you guys have in mind when you started it? What were you trying to achieve? How you doing? How do you accomplish it? I know you've got some Philadelphia area partners. You just talked about the importance of partners. So maybe give us some color on CIS.
Yeah, sure. Over time, just when we're together, Scott and I would just shoot the breeze about inbound we'd receive from he much more than me because of what he does for a living. But can I invest in the Notre Dame? Can my institution invest in the Notre Dame endowment? Or I want to invest with Catholic social values. I can't find any place to do it. Those kinds of questions that come up, and generally from relatively small, but some very large organizations. And it's like any entrepreneurial endeavor, right? The guy who founded TurboTax couldn't figure out how to do his taxes, so he started TurboTax. He's a good friend, and so we started talking about it. We're doing a lot of talking and no action. Long story short, our founding CEO, Peter Jetton, we asked to take on just a little consulting assignment for us. And we went out and listened to what people needed, frankly. And we had a quite tight mission, which was to deliver investment excellence according to Catholic principles to institutions who need it or should need it. That was the goal. And the goal was to really, and our mantra as we were starting out, and still is, if we can get those institutions 1% incremental return, it's 2 teachers at St. Joe's Prep or whatever, get on the list, just dollarize it. It's the kid doesn't go to Dartmouth, he goes to Notre Dame thing from Scott, right? And when you dollarize it, it doesn't matter the size of the institution, but that was the motivation. And we thought because of, by finding the right partners, we could bring the quality to the marketplace that the marketplace couldn't get without an intermediary like this. And we were very fortunate. Our 2 investment partners are Philly firms. The Investment Fund for Foundation had done this in a secular way and done it really well. And they were a natural place for us to look at to see if they would work with us. And they signed on to the screening aspects of what we do unbelievably enthusiastically and have done a great job for us in that regard. We wanted to extend our reach a little bit because we think adding other options beyond more liquid options is there. And we finished the underwriting of a private equity pool with, coincidentally, Hamilton Lane, who's from Bala Cynwyd, who had experience in impact investing, which is comports with our objectives. So we feel like we've passed the test of having a couple of very trusted partners, and underneath their trusted partners as well. And so, you know, the goal was pretty simple. Can we help small Catholic institutions get better returns and a better ride on their returns over time by bringing investment excellence to them they wouldn't get and doing it according to Catholic social teaching? And we're very happy. You know, we're $700+ million. We've got a great team of people doing it for us as the client relations people. And so it's been a fun journey for 6 years. And our own view is we're just starting out. We're just starting out because, and again, I've got experience elsewhere in this. It's a slow process to get people to adopt an idea. You know, when I went to Vanguard, there were $100 million in index funds. And
$6 trillion or so today, right? Or
yeah, exactly. So you know, it takes time, but every time somebody gets exposed to it, they start thinking and saying, "Jesus, this is what I'm getting. Where I'm doing do I have a trusted partner like we hope CIS has been and is to our clients?" So, you know, that's the short story, and it's a great story. You know, with all about the team doing it. But the mission is a critical part of, and we think very important to large and small and enterprises alike.
Jack, one of the basic principles here, not unlike, you know, an individual investor who wants to diversify, let's say they've got, you know, a couple $100,000 to invest, they're starting out, you know, they can't afford to go out and buy 50 different stocks. So a mutual fund is a great way for them to achieve diversification, right? I think one of the principles here is that if I have a small, relatively small endowment, $10 million, I can't access private equity. I can't access Hamilton Lane, right? So talk about the pooling benefits of what CIS is doing.
I think you hit it right on it basically is the reason that mutual funds are a $30 trillion business, right? Because all of us together have better access to things. And listen, if you look, you know, I've lived a lot of the history, but I'm a historian of the investment management business. In a sense, better ideas happen at the leading institutions and work their way to the retail marketplace. And the way they get to the smaller end of the market, whether that's small endowments and foundations or individuals, is through pooling. And so if you look at the list of our managers in Catholic Endowment Fund, most of them are closed. Nobody can get to in many ways. We do because of relationships. And their minimums are so high, you couldn't get any even if they were open. But collectively with, you know, $600-700 million, we become a very attractive looking client. And what's been impressive, I should say, Jerry, is almost nobody's turned us down when we said we need this other layer applied to your strategy, which is really encouraging. It says a lot about the firms managing our assets. But that's why pooling works, and it gives you scale. Your costs are lower. But importantly, in this space, your access is greater as well. And those two things, in one of the ways the best investment pools for permanent capital win is access, because most of the best investment providers have limited capacity. And so I'm glad you asked the question. I take it for granted, and I shouldn't. It's a critical element of what CIS brings to the table for potential clients and clients.
Yeah, no, and you hit on, I think, the other key aspect or benefit of this, Jack, as I think about small Catholic institutions, is cost, right? With the scale that you're achieving with $700 million to invest versus 10 million or 20 million, you're going to drive a lower cost structure for your investees. I just want to remind the audience we're looking to take your questions, hear what's on your mind. We're about at that point in the program, so please feel free to submit them through the Q&A line as Tom had outlined. I do have one question here in chat, Jack, and I'm going to just read the question because there's a couple sentences building up to it, but the punchline here is, in your experience, have endowments been able to promote diversity, inclusion at their institutions? And, you know, we talked about mission, talked about Notre Dame's mission as an example, how the endowment can support the mission. I suspect the answer will vary a little bit by institution, but what's your experience been there?
Well, two ways. One, in the most important way, the answer is absolutely yes, because you know, diversity, equity, and inclusion is most evidenced by the student bodies. And having a robust endowment allows you to meet financial needs for people of all means. You know, many of the great institutions were all white male, not even Catholics, 50 years ago. And you look how diverse they are today, and it's because it's A, it's the right thing to do, and B, it's funded because of outstanding investment results. And similarly, actually, there's some couple of congressmen had questions about diversity of investment teams and diversity of investment partners. And I saw the results, at least as publicized, and I thought they were actually better. They surprised me. They were better than I thought they would be in terms of mix of, you know, the number of women-owned firms and minority-owned firms was higher than I expected, to be honest. So, but it's always a priority in terms of because, and it's not to meet some mandate. It's because, like all sources of diversity, it makes us better. It makes, you know, different thought, different backgrounds, different experiences, different heritages makes us stronger as organizations. And that's the motivation. The outcome is important as well, but the motivation is there. So when I go back to the first point, though, of how the student bodies have been diversified, a bunch of that great outcome has been funded by the results of benefaction and good stewardship.
Great, good stuff. Differences between traditional active strategies, index strategies, and more sophisticated private investments, Jack. You know, what have you seen in that area with Catholic endowment funds, whether it be Notre Dame specifically or just more broadly?
Listen, I think of strategies as falling into four buckets, if you will. One is indexed, and indexed is there aren't very many good indexed strategies, interestingly, around there. If you look at the publicly available products, they aren't all that sophisticated in the way they think about screening and so on. You can get a customized product, which is better, but that's one channel. The second is, I'd call it broadly diversified active. The third is highly concentrated active, and then the fourth is private. You know, the one that has been least effective, frankly, for endowments is the broadly diversified active. In many ways, you're paying for what you could get for a lot cheaper at an index fund. And so the broadly diversified, unless it's a multi-manager structure, is the one that I think has fallen more out of favor. And what you're seeing is many of the big endowments are now indexing that part of where they used to put money into diversified active, it's gone into index products. Highly concentrated is different, and that may be a hedge fund, it may be long only, it may be something else, but highly concentrated, you pay more with the expectation that you will get more. And then very importantly, and this is a tactic that investment committees need to understand, is how are the incentives aligned in a hedge fund or something else. And it's changed a lot post global financial crisis, but that's a core strategy that people are using. It's also easier to screen. If somebody has a 15 stock portfolio, they might make it 13 because they screen out 2 and so on. So that actually has been a very helpful part of this. And then lastly, you know, private is a fourth option if you want equity exposure. And the question is how you get that. We've chosen an impact investing strategy. But we think, you know, any mix of those is effective. Some skepticism about a manager who owns 100 stocks has a beta of 101 and an R squared of 98. I'm not sure I'm not sure that's worth paying for it, Jerry, just to be blunt. The others are all very viable and ones, although I have to say, I've been disappointed that there haven't been more highly credible index strategies available to smaller investors. You can get them if you're big, but not so much small at this stage. And we frankly think about, as our product line evolves, potentially, I think, going down that road for people.
Great. I have another question that came in here through the Q&A feature, and it's pretty straightforward. Is there a minimum for an endowment to participate in Catholic investment services?
Somebody's going to correct me. I think it's, so the core product is the Catholic Endowment Fund. I believe it's $5 million, but Zayla or somebody.
We're flexible, Jack.
Okay, we're flexible.
We're flexible. So we've got some investors who are below that. So we're depending on the situation, we're more than happy to discuss a smaller investment.
Great, thanks, Tom.
And Tom, while you popped on, I probably would be remiss if I didn't mention, if the audience, if anybody wants more information or would like to get a hold of you or Zale, I guess you'll probably send a follow-up communication that will.
We sure will, and we have a fancy new website that I invite people to visit as well. But Zale and I'll definitely be following up with everybody on the call.
Great, thanks. Hey, Jack, following up on the last question and maybe drilling down a little bit, what about the role of private equity in Catholic investment portfolios? Do you have to be a certain size before you think about that, or is one of the benefits of CIS having access to that with a smaller endowment? Can you chat a little bit about that?
In some ways, the answer is yes to both, which is complicated. But as I said, for me, I think of these four categories of how, particularly, you get equity exposure. You can do the same in fixed income and others. But and so if you redline and eliminate, it's not a bad strategy to not do private, but you have to do it with your eyes open. And if you can do it with your eyes open, almost at any size, Jerry, one of the things we think we bring to the table with pools is you can access high quality private equity from a firm like Hamilton Lane as our partner at a level you can't otherwise. And so my own view is, come back to what we were talking about, what an investment committee should do. And I think every investment committee should ask themselves, are we willing to take the illiquidity risk?
Great
Can
point.
we afford to? Okay, can we afford to? Most endowments can, actually. There's a lot of individuals and institutions who are afraid of private equity. But if you were able to say, listen, we know this 10% or whatever the number is, the major endowments are 30 to 40% in privates. But this 10% is when we're willing to commit, understanding we can't pay the light bill with it. To me, it makes a ton of sense, because I think you want to get exposed. You read about it. There are more private companies than public companies, formerly public companies than private companies today. So you're giving up the potential for a return stream if you just say no summarily. You should say no after a conscious evaluation. But again, if you look and if you accept my premise that much of what happens in the investment market starts at the most sophisticated and works its way down to individuals or to smaller pools of capital, private equity is a very attractive place to be. And the price for it is you commit to 10 years. By the way, the cash, and generally you'll get cash flows back before that, but don't do it with your eyes closed on that, because you need to understand it. But I think it has a very important.
Jack. Jerry, let me butt in here again. Sorry to butt in, but CIS just had a webinar, a Private Equity 101 webinar, and the video for that is on our website. And we also have an ebook like the one we'll be sending out about investment committee best practices. So we'd be happy to share that as well. But I think that'd
Yeah,
be a
no, that's
good background for somebody who wants to think more about private equity. Sorry, Jack, didn't mean to.
Did I say anything wrong? If we did,
No.
we have to take the video down.
No. So for a Vanguard guy, you did okay.
no, that's good information, Tom, and maybe we can even share that with the participants after the
Hey,
fact. The link to
Tom,
that.
Jerry, one other lesson there, and it's not just private equity. It's frankly one of the good things for any committee to do is pick a topic. You know, my first introduction to Notre Dame Investment Committee was come out and talk about indexing. I thought they were going to kick Will out of school. They did not want to hear it. They did not want to hear it. It was one of the more uncomfortable. They happen to invest at Vanguard, but client meetings I never had. I basically got my head kicked in because they just didn't want to hear it. But Scott and Jay Jordan, who was the chairman of the investment committee, that's an amazing guy, said, we ought to hear this. We ought to hear about a different point of view. And so you, as a committee, you should pick a topic continually, and say, let's educate ourselves on the one hand, and then let's think about how it might or might not be relevant to the way we think about overseeing this pool of capital. It's a great way to continue to advance the opportunity to serve your institution well and accomplish the mission.
Yeah, no, I think that's great advice for anybody in a governance role to just try and stay current, keep learning, get exposed to new ideas. So thank you for the questions that are coming in via Q&A here. I've got a couple really good practical ones, Jack. One audience member wants to know, how should an institution that hires CIS write its investment policy statement? How does it incorporate CIS's risk tolerance and return objectives, et cetera?
So obviously, if you hire CIS, we're your partner, and we will help you not write it to our specifications in a sense, because you ought to hire us to the specifications, to your specifications, but we will be very happy to help you walk through that process. And it's, issues of liquidity, issues of return expectation, issues of composition. So we can help with that. And, and frankly, we want to have that conversation before you hire us to make sure we are best able to meet your needs. If you're looking for a T-bill manufacturer, we ain't your guys, right? You may like us, but we're not right for you if you have a zero risk tolerance, and some organizations do, and that's fine. So we want to make sure we're in sync, because we want to be your partner and you to be our partner in perpetuity as we grow together successfully, hopefully for your institution, and as we evolve and provide other services to you as well along the way. But nobody should ever hesitate to ask us about how we can help you be better, whether or not you end up being a client. But we want that marriage to be perfect between what we do and what you need.
Well said. Here's another.
I would like to add that we have sample investment policy statements that would be happy to share. So I'll share our contact information at the end, and you can reach out to us.
Great. Another really good, I think, practical question, Jack. With the need for liquidity, as you said, paying the bills, does CIS establish different investment models for unrestricted versus restricted endowment funds?
Not at this time, and that's, my guess is we will at one point in time we'll have liquidity pools. We've tried to stay very focused, Jerry, on doing as well as we can for our clients, brick by brick, if you will. But most of our clients will have a liquid pool as well, so that they don't get confused between long-term and short-term.
Got it. We have a question here, Jack. Do you have examples of investments you would avoid due to Catholic values that would be included in endowments of non-secular endowments? And they name a company. I'm not going to mention which company they name, but maybe at a high level, give a flavor for how that's handled.
Sure. Well, we have a quite sophisticated review and screening process where we look at companies, and it may be abortion related. There are a decent number of healthcare companies. There'll be guns. There'll be, you can imagine the list. If you go out to see the USCCB Conference of Catholic Bishops guidelines, they will tell you the kinds of companies that will be screened out. And you know, it's been surprising to us that many Catholic institutions don't actually pay much attention to those guidelines. As I've said, we've not seen either at CES, CEF, or other places that there's any return detriment. And frankly, we think in the long run there's a return accrual, because you know, if companies are doing bad things, they're not gonna win. So the number of, Tom, you can correct me, I forget, it's not 1,000, but it's close to companies out of a broad stock market that get screened out today.
Yeah, I think we're a little over 400 right now, and we're heading higher because we're going to be working on fossil fuels starting January 1. So we'll probably be in the 700s by then.
Great. I think we've got time for one more question, then I'm going to turn it over to Zale and Tom for some concluding remarks. But the last question we have here in Q&A, many Catholic institutions were under great stress before the pandemic due to declining enrollments, etc. Can you address further the push-pull between long-term and short-term when the short-term issues seem so great?
It's absolutely fact. It is a challenging period of time. And this is where, for me, the meld of the two stewardships, the investment stewardship and the annual stewardship, is so important. And you can't make decisions about either without looking at both. And so for me, survival mode is very different than thinking the next 20 and 40 and 50 years. And I think it changes the likelihood someone's going to want to invest for the long term. And I think that is why finance committees should never be separate from investment committees, in terms of there should be overlap, because it's so important. And it's getting the two things correct that is important. And, you know, you look at there are fabulous academic institutions in this country who will have $500 to $1 billion deficits in this coming school year. They're not at risk of survival, but boy, that changes your financial dynamics. And they're having the same conversations about short term and what do the next 3 or 4 years look like. And that takes precedence, frankly, over the endowment, over getting it and changing your endowment around, just to be perfectly blunt. The other point that I think is so important in this is unrelated to investing, but it's how important benefaction is, you know, and, you know, the benefaction component of financial success and stability is so critical. And it's challenging for a lot of small Catholic institutions. But if you think about stewardship over here and benefaction over here, again, you got to prioritize both, because benefaction can help fill a hole in the short run. And, you know, we did something, and I'll shut up, Jerry, we created something called the Student Emergency Relief Fund at Notre Dame in the midst of the pandemic for kids for a variety of purposes. It was amazing to see how people jumped in to fill that bucket, to get kids home and back, to take care of people whose family situation changed and all that stuff. So I'd never hesitate to go out, to reach out and say, you love our institution, you'll love the people we serve. This is a critical period of time and we need your help.
Yeah. Excellent. Well, Jack, thanks so much for sharing your insights, experience, some great practical observations here this morning. And, you know, when I first heard about Catholic Investment Services, I think maybe over a beer with you one night, I just thought this is such a great concept. And while it's being rolled out nationwide, I think it has particular relevance in the Philadelphia area, where we have so many, you know, private Catholic institutions, high schools, universities that I believe could benefit from the concept. So I was pleased to be a part of this morning's program. And Tom and Zale, I'll turn it back to you.
Jerry, you've been a great friend to us. Thank you. And I want to thank everybody for spending time with us today. Well said, pal.
Thank you.
Well, let me just add our thanks from CIS to Jerry and certainly to Jack for this really great program. And again, echoing the thanks to our audience for joining us. We'll be, as mentioned, we'll be following up with you in the coming days to share our ebook on investment committee best practices and also private equity ebook. And with that, Zayla's got our contact information up on the screen, but we're here to serve. And thank you again for joining us, and please be healthy and safe. I think that
Thanks, Tom.
concludes our program. Thank you.
Bye-bye.
Well.